In this next video, we are going to be focusing on Courgette, focusing on the background of the organization and the operations of it, and also some statistics about their current operations. And when we're going through this, it's important to think about how it's going to impact any future strategies of the organization, any future decisions made by the organization. For example, what is the culture like? How has the company built itself over the years? Because this ultimately will affect how it acts going forward. And also during this particular section, we'll expect to find out more information about staff, more information about the kinds of operations and to what extent that will be affected by health and safety issues, technological issues, etc. And also just a bit about the history, the culture of the company as well. So let's begin. We can see that the company was established in Courland 20 years ago by entrepreneurial brothers Eric and Axel Madsen. So actually, from a history perspective, it's quite young. When you consider that a lot of the established airlines in the real world have been around for decades and decades, 20 years is not all that long, particularly given that it has now risen to prominence, being the second largest low-cost airline carrier in Hundia. So that's an important part about the history, important part about the culture of the organization. When you think about your various different cultural web, you think about the stories, you think about the nature and the history of the founders. They were entrepreneurial brothers that saw a gap in the market. That ties into what is told about the company, the stories about the company. So it's a big cultural point there. And that's relevant information because when you think about the SBL syllabus, you think about this idea of innovation and strategic innovation and innovation-led decision-making, etc. That ties in with the company and the history of the company, the founders of the company. They were innovative. They saw gaps in the market. So that's very important points to raise there when we think about strategies going forward. Now, prior to this, they both worked in the airline industry and taken a keen interest in traveling. And it started by acquiring 2 second-hand aircraft and offering flights out of the near city airport, which we know is where the hub is. We know that is where the head office of the company now is. So it stayed within those routes, so to speak, out of near city airports. And that's located 40 miles from Courland's capital city. So, of course, Courland being a large, established economy, very developed nation, and the capital city, of course, likely to be the largest and the most economically prosperous city, as usually the capital cities are. So that's from a good location for both tourists, for people using the aircraft, also for employing staff as well. If you've got a office near a large conurbation where you're going to have a lot of employable people with the relevant skills, it's good to be in an area where they can actually commute to, because of course this isn't like the kind of job that you can do working from home, so to speak. You can't fly a plane from home, for example. So when we think about access to qualified staff, that is a useful point. And it started as what they would call a national airline, if we remember back in the first video, because they started off just dealing with internal flights within Courland from the south of the country to airports close to 2 cities in the north of the country. Now, based on their innovation, their entrepreneurial spirit, their knowledge, experience, etc., they saw a gap in the market for more convenient, affordable, low-cost travel. So again, this ties into what ultimately the strategy of the company is. What it was always about was providing convenient and affordable travel. So again, that should be tying into things to do with the strategy. When you are thinking about analysing strategies, analysing decisions and projects, think back to your syllabus, you think about the suitability, acceptability, feasibility model. Things that are suitable will be things that are tying in with the strategy of the organisation. And up to that point, the airline industry within Coreland at least had been dominated by full-service carriers. So they're very much a market disruptor as well. They changed the game, they changed the face of the airline industry within Coreland. So again, feeding back into this idea of being innovative, entrepreneurial, innovative strategic leadership, etc. The low-cost model has proved extremely popular. They like the convenience of it. They like the point-to-point service. So again, when we're speaking about potentially would we move to a hub and spoke if we were to expand, that is one of the things that the passengers actually like, is the point-to-point service. In addition to that, they significantly cheaper prices than by the full-service carriers. So convenience, price, again, the purpose of the company. Over the years, the company has focused on operating flights to and from airports across the continent, across Hundria, with the highest customer demand, and continually looks for opportunities to extend its network. So again, it's within the strategy of the organization to continually be looking to expand, continually to be looking to add new routes. And one of the strengths here of its operations being its ability to analyze the market, to identify customer demand. And that has proven to be successful. They've obviously been doing it correctly. Now, cost efficiency has been one of the main focuses. So that would suggest that it operates very much a cost leadership strategy, aiming to be the cheapest possible provider on the market. So when you think again about your generic strategies, that would be their main focus. And that is also something that should feed into any other decisions that you make as well, that their overarching strategy is based on cost efficiency, cost leadership. So from your perspective, when you're looking for things that this company should be pursuing to improve its performance, you're looking for expansion, you're looking for driving costs down. Those are two key points of how the organization expands. So something else that we will need to be mindful of as well is what are our competitors doing. When we operate a cost efficiency, cost leadership strategy, we need to be mindful about costs, and we need to be mindful about other low-cost airlines. If they cut their costs even further than ours, and they then can pass on those savings to the passengers, the passengers can then purchase ticket prices for even cheaper from them than they can from us, then that is going to have a big impact on our business, because one of the downsides, the weaknesses of a cost leadership approach, is that you often get customers who are loyal to the price rather than loyal to the company. And therefore, if a competitor comes along, it can cause them to jump ship, because their loyalty is to the lowest priced provider, not the provider themselves. So that's a big thing to be aware of. So maybe we need to be looking at what our competitors are doing, making sure we're benchmarking to them, making sure we are not being undercut by them, because that is going to be very important. And this has been delivered through developing and maintaining strong strategic partnerships with aircraft manufacturers, key airports, ground handling operators, and maintenance contractors. So all of these are important stakeholders, important suppliers of ours, the aircraft manufacturers, the airports, the ground operators. All of these are important suppliers and important stakeholders. So again, we need to make sure those partnerships are maintained. We need to make sure that we're not doing anything that is going to jeopardize those partnerships. So again, when we're thinking about building our 5 forces analysis that you'll know from your syllabus, building the stakeholder matrix, all of them are important people. Important people you don't forget. You must consider them when you're answering a question. Now, over the last 20 years, the low-cost model of air travel has continued to be popular, and there are now 30 low-cost airlines operating across the continent. So that would suggest that competitor forces might be quite high, although of course they are perhaps small compared to ours. But that also means that maybe the threat of new entrants into the market is quite high. If over the last 20 years 30 new airlines can enter and succeed, and on top of that there's going to of course be the ones that haven't succeeded as well, then the threat from new entrants may be reasonably high. It may be easy enough for companies to enter it. Perhaps there are full service carriers that are entering the market under those sub-brands that I've discussed in the previous video. And the pre-scene has also given us a breakdown of the competitors. what is really important is that 40% of all low-cost airline market share across the entire of Hungary, not just in Courland, is from 3 airlines. So they're going to be very, very competitive between these 2 companies, between LKK and Bryger. Now, what is important is these are not based in the same country. Now, that may make things less competitive or more competitive depending on exchange rates. For example, if the Broland dollar, for example, was to be in a really good position versus the currencies in other countries in Hungary, then that might help people visiting Broland or people from Broland visiting other countries and vice versa. But what it does mean is that perhaps the competition within the actual countries is not as intense. So, for example, in Courland, Courgette is still the main player. People visiting Courland, people traveling from Courland are still going to be using Courgette, etc. So that might reduce the competitiveness a bit. So what we can see is that there are 27 smaller airlines that make up the other 60%. So some of these might be slightly larger, as in that they might be perhaps in the 4 or 5%, but just not big enough to have their own slice on the pie chart here. And some of them might be very, very small, in the kind of 0.5%, etc. So that's a potential way. It might be a very expensive way, but a potential way of expanding would be to perhaps purchase some of these smaller airlines. The way they can then integrate it very quickly and easily, because they're low-cost airlines. They will be able to purchase the assets, the planes, the staff. All of that will be, in a sense, quite turnkey and can be integrated into the Courgette brand. Courgette, of course, being very well known. So that's a potential opportunity for expansion as well, particularly with regards to maintaining and strengthening this low-cost position. So obviously that could be a potential opportunity to improve market share, but naturally think about competitor activities and identifying that competitors may do it as well, and that would be a threat. If Bryger were to then purchase another few airlines and improve their market share up towards 20+%, then we start to become a lot more of a second player rather than at the moment where there's a bit more parity. They're slightly larger, but there's reasonable parity. Now, on to the growth of the organization. We can see that it has grown quite rapidly over the last 20 years, and the level of passengers has grown with the number of routes. And that would suggest that they have been, of course, purchasing the slots at the certain airports, but they've been choosing routes that are going to be beneficial. They have been very good at identifying the right routes for customer demand. If the number of routes was going up at a far quicker rate than the number of passengers, then what that might suggest is that they're choosing routes that are not necessarily particularly efficient. They're not being able to maximize their utilization, as we saw in those KPIs in the previous videos. Now, the company was listed on the Courland Stock Exchange 9 years ago, 1 year after the brothers retired. They originally retained a 35% share in the business, but since then they have sold most of their shareholdings, to the point where they no longer play a role in running the business. So they are there from a historical, from a cultural perspective, but they're not running the business anymore. What it does mean, though, is that they are going to be shareholders, and of course shareholders are very, very important stakeholders. And when you have such important shareholders, such as the large institutional investors, pension funds, etc., they are key players. You need to make sure you are running decisions by them, you are communicating them regularly, and that can also affect things like your dividend policies as well, and how you would raise additional equity funding. For example, you might want to undertake go to the market to raise more additional equity funding by creating and selling more shares. But you can't just do that without shareholder approval, because that dilutes their shareholdings. So you have to give them the opportunity to purchase them first through rights issues, etc. Also, it affects the policies regarding those dividends that they may expect, particularly if they're pension funds. They rely on that income coming from the shareholdings. If you say, well, we're not going to pay dividends in the next year because we're going to reinvest the money in the business, you can't just do that. You have to run it by them. You have to make sure that that's acceptable. And when you have shareholders in a public company, sometimes you have to think about the short versus the long term. Now, if, say, Eric and Axel still owned the business, still ran the business, it was their baby, so to speak, they may be willing to sacrifice short-term gains for long-term sustainability, long-term success. That's natural. However, if you have institutional investors who expect returns year on year, they might not be willing to sacrifice those short-term gains for the long-term sustainability. So these are key players. You must be in communication with them. You must run key decisions by them. They are someone that you're going to have to make sure is agreeable and accepting of any new strategies, any new plans, any new policies within the organization. So very, very important stakeholder that we have identified there. And what is useful is, what's nice to know as well, is they actually are providing employees with the shares. This is something that is very useful for employees. It gives them more buy-in to the organization. If they're getting a payout for their shareholdings or through the share price increasing, etc., then it's something that they're going to be more bought into. They're going to try harder because they know that perhaps even in a very, very small extent, any employee can potentially contribute to the success of the business, which ultimately is going to benefit the employees of the business. So it's quite an ethical thing. It's quite a common thing nowadays, or at least increasing, is to give employees the chance to buy into the business, to have a shareholding within the organization. Also keeps them, because usually with these sorts of situations that you have to sell your shares, you have to give up your shares if you leave. So if that is the case, then you're also giving an incentive to retain employees so they're not going to go to the competitors. So that's a benefit as well that's going to help with staff retention and also potentially reduce and mitigate the risk of staffing issues. So onto the routes and the fleet of the organization. So they've got a very extensive portfolio and very profitable portfolio across 130 airports across Hungary. This makes it very popular with customers who find the range of destinations and the frequency of flights offered convenient and attractive. And it regularly reviews its route network to exploit these demands. So again, that's part of its approach, and we can see again with the correlation between these two charts here that it has proven successful. But if there was a bit of if it was not correlated, then maybe they are choosing ones that perhaps there isn't the effective demand because there's lower utilization. But the routes, the destinations, and the passengers have gone up pretty much in sync. So that's a strength in their approach here. Also goes back to this idea of the multi-regional approach rather than the international approach is the right way to expand, particularly using that knowledge that they've built up in their home market to then exploit that in overseas markets, but without perhaps moving into the international market, which relies more on a hub and spoke approach, which is going to rely on the much larger aircraft as well. And the company has a fleet of 300 aircraft, and 75% of these are owned outright, meaning that they are actual assets of the company purchased them, but that means they're responsible for the upkeeping of them, whereas 25% are leased. Now, this is a common form of financing in the airline industry because it means that some of the responsibility for making sure that the aircraft are fixed, making sure that they're running smoothly, is with the company leased from, whether that is through a finance company, whether that is through the aircraft manufacturers themselves. Now, one of the advantages of leasing them as well is that you don't have as much of the obligations, as much of the liabilities for it. Also, depending on the nature of your leasing contract, you can actually sublease the aircraft to other organizations as well. Let's say that Corejet are 300 aircraft and they had enough passengers on a daily basis that 280 of them needed to be in circulation. Well, what are you doing with those other 20 aircraft? Are they just sitting, gathering dust? Are you paying to have them stored in hangars, at airports, etc.? What are they doing? Well, could you raise additional cash flow by leasing those to another company, to a smaller airline that perhaps can't afford to purchase their own? Lease it to them, generate some additional cash flow from those assets. And they've invested significantly in the latest aircraft that are more fuel efficient and environmentally friendly. This contributes to its low-cost strategic position because, of course, we know that the fuel prices are very, very expensive, and it's over 20% of the costs for the business. So anything that has a reduction on fuel costs is going to have a big impact on the total costs of the company. And given that this has a positive impact on reducing carbon emissions in addition to just being fuel efficient, environmentally friendly, we should be promoting this. This is an example of where we have taken steps as an organization to improve our impact on the environment. It's ethical, it's a social responsible point. It also really mitigates the risk of the fuel price increase. We mentioned earlier about competitor activity and the other low-cost airlines, Bragg Air, for example. Now, if we've got aircraft that are significantly younger than the industry standards, then we are more insulated, more secure from fuel price increases than other companies. But also, given that our aircraft are quite young, we perhaps aren't going to be in a position where we need to purchase new ones anytime soon versus our competitors as well. And that would be a huge financial undertaking. Now, the company does currently focus on leisure passengers rather than business passengers. It doesn't have business class at the moment, so there's only economy seats. And I mentioned in the first video, there are low-cost airlines that do offer business class, so perhaps there is potentially an opportunity in order to attract perhaps clients that want a bit more of an experience but still want to have a very low-cost approach. So that's a potential opportunity. Now on to technology, and we mentioned in the previous video that low-cost airlines often try to automate things as much as possible with mobile apps. EasyJet, Ryanair have these as well. Being able to print off your boarding pass or have it on your mobile phone. This reduces the cost of issuing, distributing, and processing physical tickets. So again, ways in which they can further automate, ways in which AI could be potentially used are very relevant here, but also cybersecurity is a big issue here. Making sure that there's a control system in place, audit systems in place, to make sure that these are protected from cyber risks. And I mentioned in the previous video that British Airways had their information hacked as well. There's going to be personal information about the passengers, about their address, their credit card numbers, all these sorts of things. So essentially looking at this, what we're looking to do is potentially look for ways of which further automation might be in place. They already use fully automated baggage systems. They use touchpads to reduce the laptops and printed navigational charts. This is reduce the need for flight logs, and that's helped reduce the CO2 emissions per flight. So more information stored on digital systems, more information on these big data servers, all these sorts of things could help improve performance. This is where AI comes in as well. Could an AI system manage a lot of this more effectively than people can? Because of course, ultimately that in-flight data still needs to be managed and processed and looked at. Could an AI system run through it all far more quickly, far more efficiently? So a few big issues coming out there: potential technological advancements, automation, cybersecurity as well. So I've just summarized some of those key risks there. Also the risk of downtime. If you're relying on everything being accessible on an app, what if the website's down? What if the servers are down? So those are key things, again, that we need to be in control of. But again, as you can see, all of this is ultimately about improving efficiency and reducing costs. These are big underlying principles, underlying strategies of the company. Now, the company currently has almost 12,000 staff, of which 2,000 are pilots and 6,500 are cabin crew. So quite a sizable portion of them are directly related to the aircraft, but then we'll have back office staff as well. One's in the IT department, finance, customer service, human resources, all of this are very important. Now with staff, when you see staff, you think about staffing issues. You think about any reason why staff might be upset, if there be people striking. There's been issues in the UK press with staff striking at airports and the issues that has caused, cabin crews striking, the issues that can have to operations, because ultimately you can't fly a plane without pilots and without cabin crew, for example. You can't fly a plane without people that are there to manage the back office. So taking care of staff, treating staff well is very important. They are important stakeholders. So to ensure that our staff are not going to have we're not going to have issues with them, we need to look for ways in which to improve their working situation, make sure they're looked after, make sure they're provided job opportunities, training opportunities, which we do. We offer them a meet the board chat, we offer them a newsletter, they undergo a full induction program, they have lots of career development opportunities. All these are strengths for improving the staff satisfaction, improving also the performance of the staff, The better the staff work, the more efficiently they are working, and therefore, of course, that leads to our reduction of costs, which we've been driving at throughout. And risks with staff are things to do with not working, striking. We don't want to have a high employee turnover because that doesn't look good for our reputation if we can't retain our staff. And also, it's just going to be more expensive. Now, there's a saying that a staff member doesn't even start to pay for themselves until after 6 months, because 6 months of training, it means they're basically taking more in costs for the business than they are in the output of their work, and how that leads to revenue production. So if you have a high turnover and you're constantly having to train new staff for roles because people have left, then employees are going to be less efficient, and thus that's going to have an impact on your costs. Also, if you have a high turnover, if staff are unhappy, that's going to feed into the press, it's going to affect your reputation. But also, this is a two-pronged approach for reputation, is that staff represent you. So making sure you have well-trained staff who are going to act in your best interest is good for your reputation. If you have rude cabin staff and they're rude to the passengers and the passengers don't like them, and this all those air support staff and the cabin crew were really bad, they were rude to me, they didn't do this for me, didn't do that for me, etc. That's going to have a negative impact on your reputation. It could just be that they are bad employees, that they are being rude to staff. It's nothing to do with your culture or the way they've been trained, but it's going to look bad. Oh, I'm not flying Courjets again. I really didn't like their staff. They were really rude to me, Courjet staff. You know, it's going to have a negative impact on your reputation. So that's the employees. What about the board of directors? Now, when you think of board of directors, the key thing that you should be thinking of from your syllabus is about corporate governance. Now, corporate governance is all about the way that organizations are controlled, the way they're administered, and making sure that they're run in a way that is beneficial for all stakeholders. And the reason for that is because when you have a board of directors, not founders, not owners running the company, but directors, is you have the risk of what is known as the agency problem. A term I'm sure you are very familiar with from your SBL syllabus. Now, this ultimately happens because the directors are in charge of the company. The directors choose the direction of the company. The directors make decisions for the company, but they're operating on behalf of the shareholders, who are the owners. So, for example, an issue where the agency problem might be an issue, and this is why governance was brought in the first place, the code of governance brought in, etc., is that if you are a director and you are going to be paid a £2 million, $2 million, whatever it might be, bonus, if you can improve profits by 5% in the next year, and you know that once you have finished this year or the year after, you're going to be moving to another company and being a director there, why might that be an issue? Well, that might be an issue because you think, well, I don't really care what happens in the long term. I'll just sacrifice quality, sacrifice the operations just to squeeze costs down, to squeeze profit up so that I can meet my 5% target, get my £2 million bonus, move on, and they can deal with it afterwards. So it's about securing the organization, make sure the organization is run in a way that benefits all stakeholders. The short term is not being prioritized ahead of the sustainability in the long term. Now, parts of things that are considered for this is a good mix of non-executive directors. So these are people who are not employed by the company. They are there to act as a series of checks for the directors. The NEDs might turn around and say, well, that's not actually a very good decision. That's going to jeopardize our future in the long term. We can't make that decision. And it's important to have a good mix, and it's generally important or considered right to have a 50-50% mix. Now we do, because we have 5 NEDs. 1, 2, 3, 4. And we also have the non-executive chair. So we have a reasonable mix, 5 NEDs, including the chair. We have 6 executive directors. So you could potentially have an additional non-executive director as well to make it a fair mix. You then have the chief executive officer, who ultimately runs the company, and the other board members, the CFO, the CIO, the CCO, CMO, and the CPO. all of which are involved in the board as well. And they also operate running specific areas of the business. And that brings us on to the next point, that for good governance, you need to have people with the right skills. If, for example, the grandson of one of the founders was the chief marketing officer because, they went to college and they got a diploma in marketing, that doesn't necessarily make them the right person to be the chief marketing officer of a massive public organization. So it's to stop things like that happening as well. And that's actually the purpose of the nomination committee. They're there to make sure that the right people are selected. You have the right skills, the right experience to be the best person to be the chief marketing officer, the best person to be the chief executive officer, and so on. Now, the nomination committee is very important. They're also important that they have succession plans in place. What I mean by a succession plan is who is ready to step in when one of these people leaves. So, for example, if the chief commercial officer decided that I don't want to be the chief commercial officer, I want to retire, I'm leaving, what would happen? Well, what happens when a director suddenly leaves an organization is often there is a big impact on the share price. For example, a couple of years ago, the Tesla CFO left abruptly and it caused the share price to drop by about 12%. Now, a multi-billion dollar company like Tesla, that is billions wiped off of the value of the company by the chief financial officer leaving. Now, admittedly, they left under dubious circumstances and they publicly criticized Elon Musk when they did, and that kind of would have also contributed to it. But when the new CFO was appointed, the share price rebounded mostly. So it shows you the importance of having a plan in place for who's going to step in when someone leaves, as that has a big impact on the sustainability and stability of the share price. What you also have to remember for good governance is that all of the directors need to have the right information, to have good data management principles and processes in place to ensure the directors get the right information so that they can make the right decisions. And you also have to make regular use of meetings with institutional shareholders. We know 80% of the owners of this company are big institutional shareholders, and also the annual general meeting. The annual general meeting is one where everyone, doesn't matter if you own 1 share or 1 million shares, you can attend the annual general meeting and contribute. And another part of good governance is to have those committees. And we can see that they do have them. We've already discussed the nomination committee. There's also the audit committee, ultimately responsible for setting the controls, the processes throughout the organization. The remuneration committee, they're responsible for selecting how much the chief executive officer gets paid. The CEO gets paid, the CIO, CFO gets paid. And that's important that they're paid fairly because, of course, you want the right people for the job and they want the fair remuneration for their job. But you can't let them be paid too much because that has it has to be published. So that has a big negative effect. If your employees are struggling to make ends meet, they're struggling in a cost of living crisis, and the CFO got paid a $5 million bonus, then that's going to have a real negative impact on everyone, particularly if staff haven't been given pay rises because there isn't the money available, or we can't pay you a pay rise, but all the board members got £5 million each, $5 million each. Now, that's not going to have a very good impact. So the remuneration committee are there to ensure that they're paid fairly and reasonably. Also that the CEO, CFO, etc. are not responsible for deciding their own payment. Because, of course, as you can imagine, if people were in charge of deciding their own pay, they'd probably pay themselves far too much. And as a side note, it's very important for governance. It's a key strength if they do have all these committees, which they do. But remember that they must be staffed by non-executive directors only. You can't have the CEO sitting on the remuneration committee, for example, and the chair, whilst they can sit on these committees, it would be ideal if the NEDs, so these 4 here were the ones staffing these committees rather than the non-executive chair. But the chair can sit on them, but they can't chair the committees. What it means is that generally each of these will have 3 people on it. There'll be a chair and then 2 others. Now, the chair can be one of the others, but they can't also be the chair of the committee in addition to being the chair of the company as a whole. And they also have a safety committee that's primarily responsible for risk management. Just a very quick clarification there is some students do make that mistake, that risk is about identifying issues, putting controls in places to ensure that those risks are mitigated. Audit is about making sure the controls are being adhered to, the controls are appropriate and they are being adhered to. So it's a similar thing, but there is a slight distinction there. Risk puts things in place to stop risk from happening. Audit makes sure that those processes are being adhered to. And they have a detailed, on the subject of risk, they have a detailed risk register. So this will essentially list all the different risks and will identify what the impact of those would be and what controls have been put in place. It's important that you do this because it's important that you communicate this to your shareholders. And they also have a robust ERM framework as well. Now, of course, you will be aware of that from your syllabus, but in this particular exam, don't waste too much time going through every single part of that, every single part of the COSO cube and the ERM framework and all the other parts, all those things to do with risk, because it will be more about a holistic strategic implementation of risk. But the important thing here is that the ERM is all about integrating risk and responsibility across the entire organization. Yes, the board ultimately take responsibility for it, the audit committee, etc. But of course, you need everyone bought in. You need everyone throughout the organization to be working on it. You need to be everyone in the organization identifying risk, focusing on risks, and helping solve those problems. So this is where your risk models, your ERM, your TARA, etc. would come in. And maybe it would be useful to actually, rather than just having a risk register, have a composite risk index. This is what separates, this is what allows you to prioritize risks. So essentially you give every risk a impact score and a likelihood score, usually out of 5. And then you multiply those two numbers together, that gives your risk index score. So for example, if you've got one that's a 5 for impact, that means it could destroy the business, and a 5 for likelihood, meaning I'm surprised it hasn't happened yet. That is a 5 by 5, 25. That is a drop everything and deal with this now. Likewise, you have one that's about perhaps a 1 for impact, as in we probably wouldn't even know if it happened, and a 1 for likelihood, as it will never happen. That's a 1 by 1, 1. That is a we don't need to deal with this. And that allows you to prioritize your risks. And that allows you to take care of the risks that are going to have the biggest impact. But of course, any dealing with risk needs to be mapped against the cost of the impact. Now, if you've got something that is not that likely to happen and wouldn't have that much of an impact, but we could deal with sorting it, and if the actual impact of this happening would be it would cause $1 million loss, but the cost of preventing it is $1.5 million, it's not worth dealing with. It's better to deal with the impact of it than it is to pay to solve the problem, because it's going to cost you more to solve the problem than the risk would actually have. And particularly when it's not that likely, you're saying, well, we've got to spend the 1.5 million right here and now to solve it, or there is a 10% chance that we might lose $1 million from it actually happening. So of course, in that instance, it's not matching up the cost benefit of it. And of course, everything we do is about managing costs, controlling costs. And some of the key risks for the company, so these are ones you have to factor into any of your analysis, ones that you have to sort of consider if you're having any kind of new proposal, what impact it might have on your risk, is the security needs of staff and customers, making sure that health and safety is there, making sure it's an ethical thing to do as well, making sure that everything is dealt with. Also the impact of climate change, sustainability activities, maybe more CSR programs should be in place as well. That's something that we can market, which will again benefit our reputation. Geopolitical events, economic trends, of course we know that they're volatile fuel prices. We know that all of these impact the business because it's quite cyclical. If the economy is up, flights are up, economy is down, flights are down. And also cybersecurity and general risk management as well, key principles. So these are the key risks for you to consider. So in preparation of the exam, make sure you're aware of those sort of parts from the syllabus as well, how you might deal with those as well in the exam if such a question were to arise. So those are the key facts and figures for the organization. What we're going to do in the next video is, the final video is going to look at some of that information regarding the extracts from the website, exhibit from the website, and also some of the financial statistics as well. So again, thank you for watching. Hope you have found it useful. Hope you now have a better understanding of the history of the company, the businesses it's operating with, what is important to the company, the risks of it, the nature of it, the structure of it, and all of this is going to help give you that context when answering questions in the exam. So thank you, and I'll see you for the next video. So thank you very much for watching this video. I hope you have enjoyed it, and more importantly, I hope you have found it useful. If you did enjoy this video and you want to see more of it, or if you are studying for the September 2023 exam for the ACCA Strategic Business Leader, then please do visit our website www.astranti.com. We have a free ACCA SBL pre-scene pack that includes all 3 videos for the pre-scene analysis, the strategic analysis, and the top 10 pre-scene issues. In addition to that, we also have our industry analysis document going through the airline industry and 2 ACCA SBL mock exams with complete solutions for you to practice ahead of the exam. And also, you have access to our SBL discussion board, so you and fellow students like yourself in the same position studying for this exam will be able to chat, will be able to ask questions and receive answers from our tutors. And the best part is all of this is completely free. In order to access this, please click the link in the description or visit the website www.astranti.com and sign up for our free ACCA SBL resources now. So thank you again for watching this video, and do check out that website for more free content.